All right, everyone. Hello and welcome. Today's webinar is the 2026 Employment Law Updates, your essential HR and tax compliance briefing. We've been doing this really religiously since 2020 because of all the recent changes that have happened throughout the years. And so we're excited to do it again. This year, we're adding a sort of a special component to it, which is not just the HR side, but we're going to also talk about some of the tax compliance aspects that came out with the one big beautiful bill, and so we are excited to go through that as well. Now, I'm Ali Oromchian. I'm the co-founder and CEO of HR for Health, and I'm excited to walk you through probably one of the biggest compliance years we've ever seen, which is a lot to say when we went through COVID and everything else the past 5 years. So let's get started because there's a lot to go through today. So, for those of you who don't know me, I'm the founding attorney of Dental and Medical Council, and I've spent, the last 20 years basically supporting dentists and doctors and other healthcare practices. My entire family, including my wife, are healthcare practitioners, and so compliance isn't just a job for me. It's really really a goal, but it's really very personal to me because I know how hard many of you work to do what you do with patients, and whatever we can do to make it easier for you, that's been sort of our goal. And today we're going to talk about the 5 federal law changes that happened and over 101 state changes that are going to be going into play on January 1. And when you think about that, that is a crazy amount of changes. Now, of course, we can't go through all of those today, but we're going to go through a lot of the major ones. And again, as I've mentioned before, our goal is really, really very simple, right? Our goal is we want you to be knowledgeable about this stuff so that you can ask questions and you can raise your hand and ask for help. Of course, for those of you that are already HR for Health clients and you're listening, a lot of these updates are going to be automatically made to your portals. It's very important that you have the right setting inside HR for Health, so they are done. If you have a setting set up where you need to approve it, make sure that you spend the time to approve it between now and the new year so that it all gets kind of ready for you starting January 1. If you don't know how to do that, we have an incredibly new AI kind of bot, if you will, or system that's set up on our software on the lower right-hand corner. You can ask it any question you want, and we've taught it to be very detailed in the responses, and so you'll really love the answers. It'll guide you exactly where you need to go on the software. This isn't something generic. This is something we built ourselves, so it's kind of like talking to one of our reps. So make sure you use that. Again, let's jump into it a little bit because today really we're going to cover a lot of stuff. We're going to talk about pay and pay transparency laws. We're going to talk about what we call paid leave 2.0 because a lot of things have changed there. We're going to talk about retirement plan expansions with Carey Cadle. And here we're going to probably spend, he's a CPA and he's going to spend about 15 minutes to go through the special tax segments that we have for this year because of the one beautiful bill. This applies to everyone who's listening, no matter what state you're in. So you're going to really find this important to learn, and more importantly, to take this back to your CPAs. And of course, there's a lot of things that HR for Health is doing for you there. And finally, we're going to have a 2026 sort of action plan for you as well. So let's jump into it because this is where everything starts. On January 1, there are going to be 40 minimum wage increases across 21 states. Now, most of these are inflation-based, and some, are local ordinances that you have to kind of be aware of. So you have to kind of think about this in detail. It's not just the state minimum wage or even your county's minimum wage, but it could be local, municipalities and ordinances in your city that have it. Now, if you operate in more than one city or have different roles and pay levels, it's very important that you confirm what every single applicable rate is before your first payroll in January. Now, if you're using a payroll system that isn't HR for Health, they will not keep track of this for you. And as many of you saw this year, in some situations, you could be paying actually minimum wage to your employees, like below minimum wage, because the minimum wage rules, of course, change, and your payroll company is not telling you. So this is something that you've got to keep an eye on. But yeah, wage alignment is a very, very, very big deal this year. Now, some keys for you to understand as we kind of get into this is that we have a written guide. If anybody wants it, you'll be able to get a copy of it in a little bit. You can scan the QR code that's going to pop up on your screen. If you're listening to us on your phone, just email us and you'll have the information at the end, and we'll get you the guide. But basically, you got to make sure that all your salary exempt employees are meeting the state minimum wage to be classified correctly. As many of you know, this has to be in many states double minimum wage in order for them to remain exempt. So again, really important to keep an eye on that. Now, some of these rates are now $17 to $18 an hour. So for dental and medical offices, this could absolutely impact your nurses, your assistants, front office, sterilization techs, and many others in your office. So don't take this lightly. We had a lot of complaints this year by employees against their employers because they were being paid $15, $16, and minimum wage went above those in their areas, and they weren't being paid minimum wage. And of course, there's penalties and things that apply there. So again, update your city-specific wage rates and ensure that your payroll systems that you're using are reflecting this. And you got to do this before January 1st. So this is definitely something to look out for over the next couple of weeks. Now, the advantage for those of you that are in HR for Health, we're already tracking this and documenting the city-specific changes in your portal. So you don't have to worry about this, especially if you're using our new Gusto embedded software. But for everyone else, make sure you're keeping an eye on this, as it's again really, really crucial not to violate these rules. Now, over the past couple of years, many states have been passing what's called pay transparency laws. And New Jersey and Vermont are two of the latest states that are joining this trend or joined this trend in 2025. And the reality is that from Hawaii to Colorado to now New Jersey, this seems to be a trend that you just cannot ignore. These transparency laws vary state to state, but essentially it requires employers to disclose pay ranges for the roles that they're looking to fill. Okay, so just kind of keep that in mind. Most employers now should disclose these pay ranges in job postings, whether they're internal or external. If you have salary, history questions, can you ask those? Well, those are risky everywhere now, and in many states, asking those kind of questions is completely illegal. So if you're still asking, what did you make in your last job? It's time to stop. And this is going to expand to almost all the different states. So just kind of keep that in mind as we go into next year. Now, what specifically do these laws really require for you to do as an employer? Well, there's a couple of things. One is you got to include a real pay range in the job ad. Now, that includes benefit information if required. You got to provide the pay range to your existing employees when they ask for it, right? So if an existing employee says, hey, what is the pay range for my job now? You got to provide that. And it's really important that you keep detailed records of the compensation changes that have occurred over time with your team members. Again, really important data that a lot of these laws now require. And to make sure that if you have similar roles and there are differences in pay because of experience or other things, that you have a justifiable reason for those pay differences, and that they're documented. This avoids a ton of liability. So this is one of the top areas of employment litigation right now, and we think that 2026 is going to bring even more of this litigation. So it's getting more difficult to ignore this trend. And so just kind of keep this in mind. I know it's a pain, and a lot of you don't have this in your job postings, but it's really important to put it in there. Now, if you're using systems like Indeed and other things, it's important to know that they are not responsible for making sure that you're including this information in the job posting. Some of these systems ask for it and some don't. So just kind of keep that in mind. I always recommend putting that information in the body of the job post, not just relying on the system, because you just never know what they're going to actually provide or not provide to you. So again, just it's easy to change those. Now, one compliance tip or pro tip that I'll give you is if you update your job description templates and train the individuals that are posting for these jobs to include this compensation benefits before they ever do, you're going to be miles and miles ahead. Now, we, of course, at HR for Health easily store and access, all of your job descriptions, all of the modified ones. If you need sample ones, we've got that. But between salary ranges and promotion policies, all of that is already included in there. So make sure you take advantage of it. All right, now I want to talk about non-competes, because there's been a lot of confusion about this under the Biden administration, because they tried to pass some rules to make this sort of a national law where everybody was under the same kind of rules. That did not happen. It got challenged in courts in Florida and Texas and in Pennsylvania. And so things got very messy. And under the new administration, things have kind of been shelved. But nevertheless, healthcare non-competes are tightening, especially in Texas, Maryland, Wyoming, and Pennsylvania. There's definitely stricter rules. There's more required language. You've got more protections for your doctor associates. So if you are using an associate contract, make sure you've updated these, especially if they're more than a couple of years old, because these rules need to be updated, or the language needs to be updated. If you're a provider and you've signed a contract, your state may require some very specific terms to be in your contract. So any old templates, anything you've used in the past, are not going to survive 2026. So make sure they're updated, before you give it to your associates. This is a really, really crucial part. Now I will say something funny, which really isn't super funny when you look at it, but it's happening left and right, which is that a lot of doctor associates are signing these contracts for employment without really ever reading it. And so I get a lot of calls from associates who say, yeah, I signed this contract, but I want to get out of this job now. I want to move out of state, or I want to go down the street and build my own, or buy an office. And what they're doing is, they never read the contract. So there's all this language in there about non-competes, which can be good for the employer, for many of you who are listening today. The problem is that if this language is not written correctly, then the whole contract could be void. And definitely this section of the contract could be voided. And so it defeats the purpose of why you even have this contract. So again, really important to get it updated. And if you're already an HR for Health customer, it's super easy. Just contact the law firm, Dental Medical Counsel. You'll get a 25% discount on it anyways as a member of HR for Health. So it's really no excuse not to get an updated one for this upcoming year. We are expecting these rules to change, so just kind of keep that in mind. Okay, let's go to paid leave 2.0. And there's a lot of really interesting things that are happening here, because there's a really, a national shift that's happening across the country. And there are new PFMLA programs, new sick leave laws that are being passed. There's domestic violence and safe leave expansions, right? When somebody is has to take some leave because of they've been a victim of crime or domestic violence, or a family member has. There's a lot more lactation protection laws that are being passed, and for many small employers, they're being pulled into these laws because, unlike years prior where these rules were relegated really to those companies that had 25 or more, sometimes 50 or more employees, those are changing faster and faster. And so this is probably right now the fastest expansion of leave rights we've ever seen in our history. And there's a lot of this is happening at the state level. And so really important to kind of keep up with this, because the reality is that they're not going away. Now, some states with major updates landing here in 2025 and early 2026 include Minnesota, Delaware, Colorado, Oregon, and of course Washington, which is becoming, taking the crown from California as probably the single, most difficult state to work in. But these benefits, these PMFL benefits are paid by the state, but you, as the employer, have to handle the administration side of it. Okay, so that's important to remember, right? Some of these benefits are paid by the states, but you have to handle the administration side of it because they don't have the budget for it. So this includes notices, it includes tracking leave, it includes managing job protections, and maintaining benefits during their leave, right? Maintaining benefits during their leave. So this is all really important. Now, I know many of you probably have questions about this, so please feel free to put those questions in the chat box here. We may or may not have time to go answer them live, but we will follow up with you directly. So make sure you use that chat functionality if you have any questions at all about this. And so just kind of remember that these rules, right, are expanding, and there's more and more leave being provided to employees. And so it's really important that, in addition to having the posters and all these other things that we're going to talk about that that HR for Health provides, that you need to make sure that the compliance side is there. Now, here's what every employer has to do in 2026. One, you've heard me say this before, document everything you can, right? So document the request, okay? Document the notices, your conversations that you're having, if possible, right? Your responses to the state, okay? This is really important, especially with the PFML. The accommodation discussions, okay? And then this is probably the hardest part for a lot of people, is understanding the timeline, right? How long is leave going to be for? Is it continuous or intermittent? Is it, how long does it last for? What duties are impacted by that? And then, this is something that's really important that I think a lot of people make a mistake. Do not request medical details beyond what is allowed if someone's acting or asking for protected medical leave, right? The privacy laws with regard to medical leave are immense, and they're becoming more and more strict under the FMLA and others. And so really important that you start kind of looking away from trying to get more information. Now, can you still ask for a doctor's note? In many situations, yes, but a lot of times these doctor's notes are not going to have anything that's specific in there, and you're not going to be happy about it. And unfortunately, you really can't ask more information. So don't scratch that itch of like, well, why is she out, or why is this happening? It's just, you're not going to get the answers from the doctors because they want to protect themselves, the physicians, and you could be opening yourself up to more liability. Now, let's talk a little bit about lactation accommodations, because this is also expanding nationwide. And this hasn't been the case in the past. Really, it's been pretty stagnant in terms of rule changes. But a lot now we're seeing more and more states do this. So Illinois now requires paid lactation breaks in 2026, and across the country, though, remember the rules are pretty similar in the sense that you got to provide a private space, and not a bathroom, but a private space, usually an office space. Reasonable breakdown for them to lactate. They and express their milk. It has to be paid. In most states where this is required, because it is part of their breaks if that's being offered. It's really important that you have some written policies around this, and train your managers, right? Train their managers, because they could inadvertently violate it by saying things or doing things that is improper. Now, some states do require that the private space you give them, the office, have a lock so that somebody can lock it. And this next one probably goes without saying, but I'm going to say it anyways, because we've seen a couple of these cases this year, which is if you have a camera in that private space, please turn it off or remove it completely if someone's expressing milk there. It is a violation of a lot of privacy laws and other, sexual harassment and other rules when you have a camera in your office that's videoing somebody expressing milk. So I know this seems like a simple thing to mention that nobody would do, but believe it or not, it does happen. And so really important to make sure that you are turning those off or removing them, which is kind of what I would do. So now we are expecting more leave related to postpartum recovery as well. This includes like any infant medical appointments, of course, lactation time, which we just discussed. And these are becoming more common as being something that's paid or part of the paid break. So if you're in a state that you don't have to provide paid breaks, this is being added on as something that does need to be paid. Okay, so just kind of keep that in mind. Now, with regard to domestic violence, many states, Maine, Connecticut, Washington, and some others now, as you can see from the slides, are expanding protections for employees who are affected by either domestic violence or sexual assault or stalkings. Now, this includes additional time off. It could be for court appearances. It could be for safety planning. It could be you might have to change their schedules. So once an employee discloses that the violence, and your obligation really starts immediately. And so it's really important that you have some policies and some training around this, especially for your managers. If you're a multi-office user and you're listening, it's important that each office lead or manager has this training as well. And so just kind of keep this in mind. This is an area where there's really no gray. Once somebody announces that they are a victim of domestic violence and whatnot, you have to kind of immediately fall into action and do some steps and protect them and whatnot. And so there is a lot of that. Now there is something tied to it with regard to sexual harassment that may also be in play, especially if there's patients or vendors or others that are doing things to your employees that they shouldn't be doing. But just remember, take these things seriously. The laws are expanding, and so it's really vital that you take action. Now, if you have questions about this, don't guess on this, because it's not something that's easily kind of find outable, if you will. Call the HR hotline at HR for Health, and they will coach you and navigate you through all of this. All right, paid sick time. Now, paid sick leave, started with only 1 or 2 states. Now it's expanding. As you guys can see, it's expanding nationwide, as I mentioned the last couple of years, and it's going to continue, happening. So right now in Alaska, Michigan, Nebraska, Missouri, Minnesota and Pittsburgh, the city of Pittsburgh, not Pittsburgh, California, but Pittsburgh, Pennsylvania, these rules are taking effect. And so what do you need to do with regard to tracking? Now, this is the part of the law that sometimes gets our doctors in trouble because they think, oh, I just have to provide the sick leave, but it's not just that, it's way more. You've got to do accrual tracking, so you've got to have tracking of it. You've got to have your usage rules. You got to have carryover rules into the next year. And then there's posting requirements, notice requirements, and then really strict record keeping. And in some states, this record keeping and tracking has to be done in real time, which means that the employee has to be able to log into some system or ask you for the information. You have to give it to them in real time in terms of what they've accrued. So again, really arduous, really difficult for many people. Of course, this is where HR for Health comes in. We can systemize a lot of that so that you don't have to worry about it. It's automatically calculated for you. It's automatically tracked. The employees don't need to ask you because they log in, they see their time. So if you're tracking PTO manually, 2026 is going to be your biggest and toughest year. So automating it is absolutely critical. It's absolutely critical. And you know, there's a lot of differences here between sick and vacation policies and PTO. There's a lot of confusion about that. And so if you have questions about it, make sure you reach out to us to help you make some decisions, because there's benefits and drawbacks to each. You know, for a lot of you, you know, you don't want a sick and vacation policy. You don't want two separate policies. You just want one. So the PTO is the way to go. But how it's earned, you know, whether you do calendar or anniversary, whether it's accrued or lump sum, how many hours can they use? How much can you limit their hours? Doctor's notes tied to it, use it or lose it policies. These are all things that these laws are dictating in detail. And so it's not just about, oh, they get 3 days or 5 days or 7 days. It's all this other stuff that's tied to it that makes it a liability. And so really important that you get right with this. Now, I know we talked about this, you know, about, you know, these rules, and there's a lot of creative ways that you can kind of come up with your own, you know, PTO vacation policies. You know, we've had people, you know, tie it to a lot of different kind of crazy things. And although I love the creative aspect of it, remember the law has been, you know, passed in order to kind of minimize these creative things, because they want everybody to be sort of on the same page. And so it's really important that you get really clear on who's eligible and not. One of the states that has one of the oldest sick leave policies, which is California, we still to this day get a lot of questions about, well, which employees get it? All employees get it. Oh, okay. And how do they earn it? And I mean, it just becomes really difficult. And this is the reason why there's so many of these cases. So remember, you got to have a written policy. You got to document when it's available. You got to, you know, make sure the employees, you know, are clear about whether they get that unused time if they're terminated or they resign. And then remember, the data here has to be kept for at least 3 to 4 years. And so, again, going electronic and automating it is the way to go. Now, remember, I promised you the PTO book. The QR code is right there. If you have your phones, you know, go ahead and scan that. If you're listening or watching us on your phones, which a lot of you are doing, which is what I do too, you know, feel free to email us and we will get it to you. But remember, the HR for Health advantage here is we maintain not only compliant sick leave policies for you that's updated every year, but we track the time off correctly and accurately. That is the whole point, right? You don't want to give too much. You don't want to give not enough. And then when you document these leave types securely, it absolutely allows you to control, you know, your liability and reduce your risk. Okay, so hugely important. All right, let's jump into sort of an ancillary topic here, which is the expansion of retirement programs. Now, as many of you know, this came about because of COVID, because the federal government and many states, especially the states, realized that the population doesn't have money saved in case of a disaster like COVID. And so they started mandating these policies. Now, California's CalSaver deadline is December 31st of 2025. New York's deadline phases in throughout 2026. So if you don't offer a qualifying plan today, you have to enroll either in the state's auto plan, right, auto IRA plan, or you can do your own, which I'm going to talk about in a second, because doing your own is better. But the state plans have don't require any employer contributions. You don't have any fiduciary responsibilities, but you have to handle the payroll deductions accurately, right? You have to handle them accurately. Now, one of the things we've seen is that there's been a lot of kind of good things that come from this, which is that the reality is that many of you, right, are using, right, these 401k rules to not only build wealth for yourself, because if you do things correctly with the right 401k plan, you can put a lot of money aside for you. If you have a spouse that works in the office or you have children that work in the office, you can kind of play those games as well and put aside even more money. But then you're really helping your teams by putting in and funding some of their 401k plans. Now, you might say, Ali, I don't have so much excess capital to fund everyone's 401k plan. Well, there are ways of managing it and figuring it out whereby it's not exactly dollar for dollar, but a lot of the money that you would have paid in taxes for your employees, kind of can be diverted to some of these contributions. So in other words, instead of paying the federal government some of that money, you're putting it into your team's 401k, which absolutely builds loyalty and other, other kind of benefits of it for longevity purposes. Now, what we recommend is upgrading from the free state programs, which are not great for you as the owner or the team, and to upgrade to a full 401k plan, which, if you want, can also include a profit sharing plan that can allow you to even put even more money into it for you. And for us, we have, as you know, have a really wonderful integration and relationship with Gusto Embedded, which is part of Gusto's payroll system. And right now, if you implement this 401k plan through Gusto and HR for Health, through our system, you can do it in about 9 minutes, which is a crazy quick amount of time to get set up on 401k. And everything's automated for you, so you don't have to worry about how money is being transferred or where it's going or whatnot. We automate all the payroll deductions. You get even better recruitment tools, better retention tools, and you'll have access to even more and more benefits for your team. So you have to comply. We know that there's no way around it anymore. This is the deadline. This year is the deadline. So you might as well offer it in a better way for them. And of course, you can, if you don't want to switch to Gusto's Embedded, you want to stay with your own payroll company, but you're using our HR platform, of course, for all your compliance, let us know that. And there are other 401k options we have for you where you don't pay as many fees. Please remember, right, that what's really important, a lot of these payroll companies, the reason they are, fighting for your business is because they want to overcharge you on all the 401k side of it, right? They don't care about the payroll side, right? No one likes the payroll side. That's why their customer service is so bad. But they just want the 401k side of the business. And that's where things can go really wrong with them. And so just kind of keep that in mind, as you sort of contemplate, what you want to do going into 2026. But if you work with our team, if you work with sort of some of the strategies we have, I think what you'll see is not only will you pay the lowest fees that are out there, but two, more importantly, you get to build wealth, not just for yourself and your family, but also for the team by some of these really cool strategies. So just kind of keep that in mind. Now, we're getting into the tax segment next. Okay, so now many of you know that there's been, President Trump has passed the one big beautiful bill. It's super confusing for many people. You're not going to become a tax expert today, but the good news is that we have a tax expert today. We have Carey Cadle here with us, and he's part of Mike White's firm, and as many of you know, who's a really big partner of us. And what we're excited about having Carey here is that he's going to give you the outline for what you as a business owner need to know from an HR perspective for the one big beautiful bill. Now, there's a lot of other tax stuff. We're not going to go through those. We're going to be focusing on the things that are HR focused. But Carey, thanks for being here. We're excited to have you, and I'm going to let you jump in.
Wonderful. Thank you, Ali. I appreciate the opportunity, and I'm grateful to be here with the group to talk a little bit about the One Big Beautiful Bill Act. It's taken on a lot of different names. I've heard it called OBBA, OB3. We're just going to call it the tax bill. But as many of you know, it was passed on July 4th of this year, and has very impactful legislation to just about everyone in the country. And so, by way of background, as Ali mentioned, I'm a principal with CLA, and been with CLA for 21 years now. I focus on taxation and work almost exclusively in the healthcare industry. So I also have a long background within my family in healthcare. My mother is a nurse. My father-in-law is a nephrologist. I've got a daughter studying nursing. And so I've got a lot of passion around the healthcare space. And so, Ali, if you could advance the slide a couple here, I believe you've got control of that, but we're going to dive into the One Big Beautiful Bill. And so, as many of you may have heard, this is a massive tax bill. It's 870 pages long, impacting everything from individuals to businesses, nonprofit organizations, university endowments, hospitals, and more. But we're going to scratch the surface a little bit today and talk about some of the provisions that we think are most impactful to you and of greatest interest to the group. And so in just a minute here, we'll dive into some of the key individual provisions. But when I take a step back and look at the different provisions of the bill, I kind of group them into three different buckets. There are a significant portion of the bill is really just maintaining the status quo. And not to be underestimated, but the Tax Cuts and Jobs Act of 2017 was set to expire at the end of 2025. And many of the provisions in the tax bill extended or made permanent those provisions of the TCJA. This includes things like lower tax brackets and rates, the pass-through entity deduction, and a few other things that we're going to talk about today. The second bucket really relates to items that have kind of come and gone over the years. And these are things that are typically adjusted with tax legislation and might include things like bonus depreciation or items that may have come and gone. And then the third bucket really relates to brand new provisions. And that would be things like no tax on tips or overtime. And so we're going to dive in and talk about each of those three different buckets. So this slide that you see here goes over some of the key individual tax provisions of the OB3 bill. The first box you see there talks about tax rates. If the bill hadn't been passed, the top tax bracket would have increased from 37% today to 39.6%, which was the top tax bracket prior to the TCJA. And so one of the main things that the bill does is preserve those current lower tax rates and brackets. There's also a permanent repeal of the personal exemption. And some of you may recall that from back in the day when you'd fill out a W-4 and you'd say, oh, I want to claim, 3 exemptions or 5 exemptions, whatever the number is. So there used to be a deduction for about $4,050 for each taxpayer spouse or qualified dependents. That went away as part of the Tax Cuts and Jobs Act and permanently went away as part of the recent tax legislation. What replaced that, though, essentially was an enhanced child tax credit. And so previously, the child tax credit was set at $1,000 prior to the Tax Cuts and Jobs Act. But as part of the OB3 bill, that's now permanently increased to $2,200. Another significant individual impact to the bill relates to the alternative minimum tax. And it's a little bit of a nuanced topic, but prior to the Tax Cuts and Jobs Act, many middle and upper income individuals ended up paying additional tax in the form of the alternative minimum tax. As part of the bill, there were increased thresholds for phase outs and exemption amounts that made it so that the AMT or alternative minimum tax impacts far fewer taxpayers than it otherwise would have. Another item that's an important part of the legislation relates to premium tax credits. And those came into existence as part of the Affordable Care Act or Obamacare medical insurance plans. And when those came into be enacted, there were subsidies that were granted, and then there were enhanced subsidies that were offered during COVID. But those enhanced subsidies will be eliminated at the end of this year. And then there will be essentially requirements to repay any premium assistance that's been received if you underestimate what your income is going to be for the year. So something to watch out for there. So it's a little bit of a mixed bag. I would say overall, very favorable items in terms of helping minimize tax liability for taxpayers, but some provisions were revenue raisers and may impact certain individuals negatively. So on the next slide, there's a few other individual provisions that are noteworthy. Back in 2017, when the Tax Cuts and Jobs Act was enacted, the standard deduction for individual taxpayers was essentially doubled. And so that meant that more individuals were able to claim that standard deduction without needing to itemize and helped minimize tax liabilities. That was made permanent as part of the OB3 bill, where it was slated to go back to its previous levels. One lesser known provision that will impact taxpayers in the top tax brackets relates to itemized deductions. And so, as I mentioned before, the top tax bracket under the current law is 27%. And beginning in 2026, as a revenue raiser, if you're in the top 37% tax bracket, you would think that your itemized deductions would give you a deduction at 37% against your tax liability, but it's actually reduced to 35%. So it's essentially somewhat of a haircut related to itemized deductions for taxpayers that are in the top tax bracket. One other item that has been not around since the 2017 Tax Cuts and Jobs Act is miscellaneous itemized deductions. Some people were hoping that would be back as part of the OB3, but those were permanently eliminated. And that would be a deduction for things like unreimbursed employee business expenses, investment advisory fees, tax preparation fees, et cetera. So all of those, unfortunately, are now permanently suspended. One portion of the bill that got a lot of press as the provisions were being negotiated related to the SALT cap. And so taking a little bit of a step back, prior to the Tax Cuts and Jobs Act, it used to be that individual taxpayers could claim an itemized deduction for all of their state income taxes and real estate taxes paid. With the passing of the Tax Cuts and Jobs Act back in 2017, that was capped at $10,000, which was an unpopular provision, especially in many high tax jurisdictions like California. And so, as part of the bill, that SALT cap, which is the limit on how much you can deduct in state income taxes and real estate taxes, was raised to $40,000, but only if your income is below the phase out threshold. So that's something that may benefit a number on this call. If your income is over the phase out threshold, there's still opportunities to get a similar deduction if you're self-employed. And we'll talk about that in a little bit regarding the pass-through entity tax deduction. And then finally, one benefit is there is now a temporary deduction of $6,000 for individuals age 65 and older. And essentially, that was intended to fulfill a campaign promise of eliminating tax on Social Security. That was essentially the way that that was accomplished. So a lot of provisions impacting individuals, and we're going to move on now to some impacts related to charitable contributions, which again is probably one of the lesser known provisions of the tax bill. So now there's two different changes that'll be coming into play in 2026. The first is that there is a new deduction for individuals that don't itemize. So individuals that claim the standard deduction can now claim a deduction of $1,000 for a single individual or $2,000 for a married couple filing jointly for charitable contributions. So that's a significant benefit for individuals that do give but may not otherwise itemize their deductions. On the flip side, there's also a haircut related to itemized deductions of 0.5%. And so just by way of example, the way that works is we'll say we have an individual that's got income of 300,000. So the first $1,500 of charitable contributions, which is 0.5% of the 300,000, are now non-deductible. And so there's also that further limit, though, that I mentioned previously, where if you're in the top tax bracket, not only do you get that haircut, but then you also only get a deduction for 35% of your charitable contributions as opposed to the 37%. So some slight limits to deductibility of charitable contributions. And one planning point there that you may have heard recommended by financial advisors, CPAs, others, relates to doing charitable contributions in 2025, potentially accelerating charitable contributions using a donor advised fund, something along those lines, to get the full deduction in 2025 before those limits come into play in 2026. So we've spent a lot of time talking about individual provisions, and we're going to wrap up with a couple of slides on business provisions. And so under the old law, bonus depreciation was a very popular provision that essentially allows you to expense in the year of purchase equipment or other items purchased for business use. That had been phased out or in the process of being phased out and was going to be down to only 40% bonus depreciation being eligible, going all the way to zero. But as part of the bill, 100% bonus depreciation is back for any equipment, which would include vehicles, furnishings, office equipment, et cetera, placed in service after January 19th of 2025. There's also a new category of property that's eligible for bonus depreciation. Probably doesn't apply to this group, but it would be in a manufacturing setting. That property as well, even if it's a building, for example, could be eligible for bonus depreciation. There's also expanded 179 expensing opportunities, and it's a little bit nuanced with the distinction between the two, but bonus depreciation can create a loss. Section 179 depreciation can only bring your income down to zero. So sometimes it's helpful to be able to have essentially a mix of those two for tax planning purposes. On the last slide that we have here, I'm sorry, second to last slide that we have is a significant provision related to R&D costs. This is a very taxpayer favorable provision. It may not apply to too many on this call, but beginning in 2022, any R&D expenses were required to be capitalized and amortized over time. And so it's a disincentive for businesses to be doing research and development. That went away, and as part of the bill, businesses are now able to fully expense the research and development expenses, and they're also able to claim a deduction for any of the prior R&D that they had to capitalize in prior years, which is very favorable. And then on the last slide, two very favorable provisions were made permanent as part of the legislation. The first one relates to what we call the qualified business income deduction. And essentially what that is it's a deduction for income from a pass-through entity. That would be an S corporation, partnership, or LLC, where that income is taxed at a 20% lower rate than the standard rate. So if the top rate is 37%, income from a pass-through entity would be taxed at 29.6%. There are limits, though, for healthcare professionals that you may be familiar with, and so that does phase out with income above about $500,000. And then the last is the pass-through entity tax, which is one recommend for just about all businesses, which is an opportunity for businesses to make state tax payments on behalf of their owners and claim a federal deduction for those state tax payments that may otherwise be non-deductible if made personally. So with that, I know we moved very quickly and we just scratched the surface on a number of different provisions. If you do have further questions, you're welcome to drop it in the chat. Be happy to follow up with you, or you may want to reach out to your CPA. So overall, I would say the bill was very taxpayer favorable, with maybe a few revenue raisers that were thrown in that you may need to watch out for. And with that, Ali, I'll turn the time back over to you to wrap up.
Thank you, Carey. Yeah, no, this was wonderful, and for everyone who's listening, obviously, you know, this is very high level. We don't expect you to kind of be able to take all of this and apply it to your own situation, but the hope is that if, for example, you do have, commercial real estate or residential real estate that you're renting, and you don't know how these things apply, this is the time to take this information to your CPA and say, hey, this is what I was just, this is what I learned. How does this apply to me? Or reach out to Carey or reach out to Mike at CLA, and they can kind of walk you through it. They do a really wonderful job of it. The other thing that Carey mentioned that I think a lot of people don't realize, especially if you're using an out-of-state CPA, if you're in any state and your CPA is out of state, a lot of times we see them miss this pass-through entity tax workaround, or this, or even just making the PTE, tax on behalf of their clients. And so it's really important that you work with someone who is not only healthcare focused, but also understands these rules in the different states, so that you don't miss these opportunities. Because, Carey, I mean, this is just money on the table, right? That the states are allowing you to take advantage of.
Definitely, it's a huge opportunity that all business owners should be looking at if they haven't already.
Yeah, absolutely. Well, thank you, Carey. Thank you very much. And I'll leave one more thing about this tax stuff, before we go to the HR topics to end today's presentation, is this: if any of you are thinking of selling in the next 1 to 5 years, and you want to talk about how to minimize and in some situations eliminate your federal long-term capital gains tax, come reach out to me and our team, and we can kind of talk to you about that and introduce you to some partners that can help you do that. It doesn't help with the state taxes, but it can help minimize some of the federal tax. And and that and if not all of it in some situations. So there are some real strong strategies there that are legal, that are easily doable, but you just need to work with a group that understands it. And so yeah, reach out to us if you're in that category, 1 to 5 years out, and you want to eliminate or significantly minimize your taxes. All right, thank you, Carey. Let's go now
Thank you, Ali.
into. Thank you. What do we do about 2026? Now that we've learned all of this, how do we take the right steps to protect ourselves? And so I'm going to break it down into just a couple of really important steps for everyone to kind of do as we move forward. So number one, if you're an employer and you're listening, you got to do a couple of things. One is you got to update your pay postings, and so make sure that you're paying people correctly. For the minimum wage. Make sure your postings that you have in your office are up to date. If you need any information about any of those, reach out to us, of course. This is related to what we were talking about earlier, the minimum wage stuff, the pay ranges, the non-compete languages, all of that needs to be sort of updated. So make sure you're doing that first. Second is if if you have employees who go out on leave, which all of us do for a variety of reasons, make sure you tighten up your leave language, okay, in your policies, in your manuals. Your time off management language needs to be tightened up as well. This includes, information about sick leave and FMLA and all the other federal and state rules related to paid family leave. And then update your rules regarding domestic violence as well. Now, again, if you're already an HR for Health customer and you're listening to this, don't worry. You know that your manuals going into 2026 are going to be updated with all of these rules. You just have to make sure that you accept them. And so if you don't accept them on the system, it will not be in effect in 2026. So we don't do it automatically. We do it for you, but then you have to approve it. So make sure you do that. Again, if you have any problems with it, make sure you ask our help desk. Number three, postpartum language, lactation needs. These policies need to be updated in your system. Make sure you have a lactation space for your employees if they do, require that. And then, of course, update those policies and then train your managers, right? Train your managers. So those three are hugely, hugely important. Now, as we go into item number four is check your benefits. Make sure you are compliant not just with the federal rules, but the state and your local rules, okay? And then have your record keeping there. Right? In today's seminar, we talked a lot about retirement plan requirements that have been done. You got to make sure the payroll deductions are correct. Your leave records and wage records are all compliant. As Carey mentioned, the one big beautiful bill has a lot of language in there regarding how overtime is taxed and how it's not taxed and things of that nature for some employees. And so all of that record keeping needs to be done. Of course, we at HR for Health and our payroll system through Gusto is completely compliant in this regard. We're doing all that work on the back end for you, so you don't have to worry about it. It's for everybody else that I worry about. So make sure you have those things in place. And then finally, make sure you have a 2026 compliance checklist, right? So if you have map every legal change that you want to do in terms of your policy updates, system updates, training updates. If you need help with this, let us know. We will help you do this. And if you just don't want to deal with it, you don't want to do the mapping, you don't want to do them, this is where HR for Health is valuable and does the heavy lifting for you. I mean, that's why I created it, was so that it does the heavy lifting for you and you don't have to worry about it. Again, let us help you kind of manage this. Now, how does, for those of you who are not as familiar with HR for Health, what you need to really know about the software is that we've got state-specific auto-updated handbooks for you. We've got the timekeeping in which automatically tracks breaks, accruals, sick leave, all of that is automatic. We've got the digital records if you're ever audited or if there's ever any disputes. I can't tell you how many litigations our clients, sometimes are in, that we can get rid of very quickly because of the documentation we have. It's incredible. The payroll and benefits compliance is going to be huge in 2026 because all the changes we've talked about, especially with our new retirement programs and insurance programs that we have because of the new state mandates, right? So again, remember, we're ahead of this so that you can be ahead of it. And then, of course, there's all the other tools that we have that are specific to you as a healthcare practice. Our scheduler, our violations tracking, and our data regarding absences and things. This is where we, really thrive and where we do our best. And so that's where we are. If you are a current HR for Health client, and we've got some special promotions for you if you refer a friend. And so you can scan that QR code. If you're new to HR for Health and you want a friend with benefits, make sure you scan that code and reach out to us, and one of our team members will follow up with you. And as always, we are here to serve you. We have been doing this forever. We just celebrated our 19-year anniversary at the law firm, and our basically our 13-year anniversary at HR for Health. So we are here to serve, and so please let us help you navigate all of this. Reach out to us whenever you need to. We're here because we really believe that you deserve to have a friend in HR that supports you. All right, everyone. If we don't talk before, have a wonderful rest of the year, and we will see you in 2026. Thanks, everyone.